Thinking of buying property in Gift City because you've heard it's tax-free? Well, welcome to this explainer. Today, we're going to absolutely dismantle this super pervasive myth that all investments in Gift City are just magically entirely tax-free for NRIs. There is so much marketing hype out there, but right now, we're going to look strictly at the facts, the data, and the actual reality of the laws.
So let's just jump right in. Are you thinking of buying property there because someone told you it's a zero tax haven? I mean, that's probably the main thing driving your investment curiosity right now, right? Well, here's what you actually need to know. Gift City is home to India's International Financial Services Center. And yeah, it absolutely offers some incredible tax incentives for certain regulated financial businesses and products. But, and this is a massive but, that doesn't mean every single investment inside the city limits gets those same perks. Okay, let's quickly define this IFSS thing because understanding this super regulator is basically the key to finding where the real tax magic happens. It acts as a unified regulator that combines the powers of all the big players, RBI for banking, SEBI for markets, plus PFRDA and IRDA. It's essentially a specialized offshore financial center, legally speaking, sitting right there on Indian soil. So we've got to draw a hard line in the sand right now between buying physical real estate and investing in an IFSC financial product. Because guys, they are treated wildly differently. If you buy a physical asset, like an apartment, you're stuck with standard Indian tax laws. But if you invest in an IFSC product, that's when you unlock those celebrated tax exemptions. This quote really hits the nail on the head. A residential apartment in a non-SEZ tower follows normal Indian tax rules, period. If you're buying an apartment or a commercial office, the tax treatment is generally exactly the same as anywhere else in India. The location alone doesn't just hand you tax-free income. Actually, scratch that. It literally doesn't at all. Here's the reality check. Your rental income, your capital gains, and FEMA rules continue to apply under the normal legal framework unless you've got a specific institutional exemption. You're taxed on income from house property, you still get your standard 30% deduction for repairs, and yep, normal capital gains rules totally apply when you eventually sell the place. And honestly, it gets heavier. If you rent that place out as a non-resident, your tenants are legally required to deduct a massive 31.2% in TDS, that's tax deducted at source, from the very first rupee of rent they pay you. There's no minimum threshold, just a huge upfront tax hit. Being in Gift City does absolutely nothing to shield physical real estate from that. Plus, FEMA rules still completely dictate what you can and can't buy. As an NRI, sure, you're permitted to buy unlimited residential and commercial properties, including in Gift City. But you are strictly prohibited from buying agricultural land, farmhouses, or plantation properties. The fundamental rules of Indian property ownership, they haven't changed one bit. Okay, moving on to Section 2, the true tax haven, focusing on IFSC financial products. So if physical real estate isn't the tax haven, what is? Well, when you invest in IFSC-regulated alternative investment funds, mutual funds, or foreign currency FDs, that is when you unlock those jaw-dropping, headline-making tax promises. We're talking 100% tax exemption on derivative income, zero TDS on foreign currency fixed deposits, and some serious capital gains exemptions for specific funds under Section 1040D. This is the real-deal, institutional-grade tax neutrality that global capital is actually looking for. But, you always have to ask yourself, tax-free where? Because while India might not tax these products, your global tax situation is a whole different beast. If you're a UAE-based investor living in a zero-tax setup, awesome, you keep 100% of those gains. But US and UK investors, you guys still have to navigate your home country's complex reporting rules. The UK wants to know about all foreign income, and US investors could even trip over those super complicated PFIC rules. Next up, let's talk about the repatriation superpower, frictionless capital movement. Just look at this table. It perfectly contrasts the painful, paperwork-heavy nightmare of moving money out of mainland India with the totally frictionless process in Gift City. On the mainland, you're drowning in Form 15CA, 15CB, chasing down CA certificates, and waiting weeks. In Gift City, poof, gone. No CA certificates, none of that documentation, and your money moves in a matter of days, sometimes even the same day. It's literally USD in, USD out. Because Gift City is legally treated as a foreign territory on Indian soil for these purposes, your money flows exactly like it would between, say, New York and London. There's zero forced conversion into rupees. Dollars in, dollars out. Euros in, euros out. It's a completely seamless system built specifically for global investors like you. All right, wrapping things up with our final section, the verdict, strategy over hype.
Before you invest a single dime, you really have to understand whether you're buying physical property or investing in an IFSC financial product. Because, like we've seen, they are treated very differently by the tax authorities. Buying property, that's a real estate play. You're betting on structural supply deficits and corporate leasing demand. But investing in an IFSC product, that's a pure offshore tax neutrality and frictionless capital flow play. Both are great, but they serve completely different purposes in your portfolio. Know the difference. Invest with confidence. So, are you ready to look past the marketing hype and actually use this legal framework to your advantage? Or are you going to let a simple misunderstanding cost you 31.2% in unexpected taxes? The facts are right here in front of you. Now it's up to you.